Welcome to the Jill on Money Show. It's Sunday, November 17th, and today we're airing the second part of my appearance on Ask the Compound with Ben Carlson and Duncan Hill. Again, this is a program that is on a YouTube channel called The Compound and Friends, and we have a show there called Jill on Money, powered by The Compound. You can check that out, and we've got links to it from our website, Jill on Money. In this part of the interview, Ben and Duncan and I are talking about someone who wants to retire at age 36. Wow. This starts with Duncan reading the question, and sometimes we're referencing charts, but don't worry, it still works for audio. Check it out.
Okay, up next we have one from David. I'm planning to retire next year at age 36 on a 5 to 6% withdrawal rate from my non-retirement accounts. Given that I can't touch my retirement accounts for another 23 and a half years without paying penalties, would you recommend doing annual Roth conversions up to the standard deduction to avoid paying taxes, to avoid overdrawing from my non-retirement accounts?
Big time fire guy here, 36 years old.
Wow, what are you going to do? What's he going to do at 36?
That is the big question. What are you going to do with your time? Probably become a fire blogger, I would imagine. First blush, 5 to 6% seems high, but it sounds to me like he's going to use the 5 to 6% for the next 20 whatever years while he can't touch his retirement accounts, and then transition into using the retirement accounts from that point. So I guess the 5 to 6% at an initial blush seems high, but it's probably not as high as it seems because that money will probably run out eventually, I guess, would be the option. So let's say that his plan works out and he retires at 36, then he can finally start using his retirement assets in like 25 years. Does this make sense to the annual Roth conversions? Are you on board with that?
Well, I'm unclear because I need to know the actual dollar amounts. So I think the problem is, like, I would hate to soak up all of your liquidity doing Roth conversions. That's the only thing that I'm worried about. So, if you have it, I don't know what the numbers are. So let's pretend he's got $2 million in his retirement account and $1 million in non-retirement account. And he's just going to let the retirement account go. Do you really want to use your non-retirement assets to do the conversion with the fear that you are overly ambitious? Like, it would be great to do it at 12%, fantastic, but I am concerned that you don't soak up all the liquidity in the non-retirement accounts too quickly. That's the issue for me. So you tell me how much money you have outside and how much money you have inside those tax deferred accounts, and then I think we have a better chance at giving you an answer that makes more sense for you.
I get that, because maybe you're setting yourself up for the future, but you're hurting yourself in the present to do so.
Right. Exactly.
And you have to maybe balance that a little. I do think your point about what are you going to do with your time here is something that probably not enough folks pay attention to. And that people in their 30s or 40s or 50s or 60s, right? Like, what are you actually going to do with your time?
Ben, I cannot tell you how many times people come onto my pod and they'll say, I'm 52 and I want to retire. And my response is normally, what? What are you going to do? And that's probably because I am turning 59 and I can't imagine really being done. And I think the number of people who are not giving thought to this, even if you're in your 40s, your 50s, your 60s, having some semblance of an off-ramp to get you from like balls to the wall working and really like pushing it to doing nothing. I think there's a real danger in that. And the people that I know, I'd hate to be the kind of person. I know so many folks like this. It's like they work really hard, they get to the number, they're done, and then they actually are like completely bored and don't know what to do with themselves. And they're driving their spouses crazy. And then they end up going back into the disgusting rat race, doing something really that they worked so decades to get out of. So when you're thinking about retirement, think about, is there some period of time? Is there a 5-year period where I can do something a little different, where I could maybe give my notice, but then act as a consultant, or where I can say, I need to make sure that I have something to do with myself. You are likely, if you're going to retire at 36, 46, and even 56, let's say you retire at 56, you could live for 35 more years. Are you going to do nothing? Nothing for 35 years? I doubt it. You're going to have to figure out how to occupy yourself.
The sense that I get from a lot of the FIRE people, financially independent, retire early, is a lot of them hate their jobs. And that's the reason they're doing this. It's like, I'm going to take big time pain now, tons of delayed gratification, and then I'm done and I can leave this job. So the point, if that's your case, then I get that. I would not want to be part of a soul-sucking job. I've had jobs I didn't like in the past. I understand how that works. But I think then you need to figure out, okay, what do I really want to do then? Like now, if you've given yourself the financial freedom, now go do what you want to do. that can actually make you happy.
You know, one of our listeners, we discussed this, and the person, we just kind of came up with a new acronym. Instead of FIRE, I think that most Jill on Money people are more like the FINE acolytes, meaning that financial independence next endeavor, that people want the opportunity to do something different and to save. Maybe you don't have to have the same level of pain and deprivation. Maybe you can just say, well, I'm going to save a little bit more now because maybe when I'm 45, I'm going to want to do something different for 10 or 15 years. And that next or that new endeavor is such an exciting thing for people. And I think can really be a valuable part of your own personal growth. Like if you've done the hard work, you've got the money, but now you really can take a change and do something and make yourself feel better, be part of a mission-driven organization, which has its own problems perhaps, but just doing something different that you're psyched about. A lot of people, Ben, that come on my program, they'll say to me like, I really want to become a financial planner. I'd love to do that. How do I do that? And we talk
Sounds
about
relaxing.
the steps. Yeah, it's kind of awesome. Like, hey, no, it's not so much relaxing, but like, it feels like you could do good. Like you could do good in the world helping people. Like Ben.
Did you trademark the FINE thing yet? I like that one.
You know what? I think I put it in my book in The Great Money Reset, but it really is, I think that it is more of a known quantity. So please use it.
But especially with people living so much longer these days, even the baby boomers that are retiring in their 60s, like you said, 30 years maybe, like you have a whole second act potentially that you could be doing something with.
Yeah, and I do think that the engagement, I think that people really discount social engagement. I had a friend who actually stopped teaching after teaching for 40 years, 40. And she goes and she substitutes and she works as a substitute in her system like a couple times a month. And she said, it's like my Pilates money. I get to hang out with my friends. I get to be with the kids who I love. And like on a little, like twice a month basis, fantastic. So
my dad retired at 62, I think, probably a couple years earlier than he thought. He did okay, and he's like, all right, I'm going to do it. And he went to work at a winery so we could get a 50% discount on the wine.
Love that. We had a guy, by the way, on the show who ended up, he loves tennis, and he works for the USTA and travels around the country for USTA tournaments, like driving professional tennis players from the venue to their hotel. And he gets to go to all the tournaments for free. I'm like, that's an awesome job.
I like it.
Yeah.
Last but not least, we have, as a long-term investor, I've accumulated substantial capital gains in Mag 7 stocks, which now dominate my portfolio. I'm increasingly uncomfortable with the concentration risk. My dilemma is, how can I balance tax efficiency with the need to diversify my portfolio and reduce risk? I'm hesitant to let tax considerations dictate my investment decisions, but I also don't want to incur unnecessary tax liabilities.
This is the kind of question where people want to look at it from a outcome-oriented view, right? Like, I don't want to sell and the price keeps going up, but I do want to sell if the price goes down.
Yes.
And obviously, we don't know what the price is going to do. So you have to make sure that you're making this decision with only what you have now, and don't look back on it in the future and try to regret one way or the other. Like, I should have done this or I should have not. You don't second-guess this kind of decision. You do it. But this is the kind of question we get all the time from people, especially in these kind of, which, boo-hoo, you have too much NVIDIA gains, right? Like, you won the game. Taxes are part of playing. But where do you fall on the tax tail versus the dog?
Dude, I
portfolio?
love paying taxes. I love it. I think that like tax minimization is great, but like you killed it on a trade, take some money off the table. Oh, here's another idea, by the way. Why don't you create a charitable account? You can do it at Fidelity, you can do it at Vanguard. And you know what you can do? You can gift your shares into your charitable trust. This is a donor advised fund. You can gift the shares in there. You can get a tax deduction this year. You don't have to give all the money away for years to come. Like it can be like a few years in the future, but you can get some of that money off the table, get a tax deduction for that, by the way, and you'll have all your charitable giving set up for like a bunch of years. And this is especially good if you want to like bunch your deductions. You want to get this all in 1 year where you're making money. But generally, if you're not charitable, okay, I get that. And a lot of people don't have that as part of their plan. Sell a little bit, pay the tax, move on. 23.8% is your top bracket. It ain't the worst thing in the world.
Right. Yes, it could be worse. You could be trying to harvest those losses.
Exactly.
But I don't think, I think the bigger regret for most people would be I held on too long and a lot of my gains disappeared.
Yeah, I mean, look, I know that and I get that feeling, but you don't look back. You say, sometimes the best decisions are made by accident. I remember I had a client 100 years ago when I was still in the business, and they were selling their Texas Instrument stocks. It was 1998, okay, the end of 98, and they wanted to buy a house in Florida. So we sold a bunch of the Texas Instrument stock, took the gain, and then, for 1999, it looked like the worst decision in the world because the stock kept marching higher. And then the entire thing collapsed, 6 months after that. So in 18 months, this guy felt the agony of defeat, but then had his eyes wide open and said, oh my God, I was the luckiest person in the world to sell at that level.
So I have a story. I'm not trying to one-up you here, but we have a story of someone who came with us and their whole portfolio was in XIV, which was like the volatility enhanced whatever. It was trading on the VIX. And this thing was going crazy, and it was basically betting on low volatility to remain forever, right? And they came to us, and we said, no, you cannot have this as your whole portfolio, any of your portfolio. Like, this is a day trading vehicle. And so we had them sell it because it was prudent. And then the ETF proceeded to double over the next 3 months. Oof. And they called us and said, what is wrong with you? A week later, it literally went to zero. Remember that XIV, Duncan?
Oh, yeah.
Volatility, and it wasn't even like a crazy correction. It was like a 10% correction. And however they structured this ETF, it blew up and went to zero. And they kind of went, okay, got it. You're good now.
Think of the tax loss harvesting opportunity there.
Oh, yeah, right. From gazillion to zero. You know what? And the other thing is, sometimes you make a decision and it can just be a prudent decision that doesn't work out perfectly well. But, sometimes you make that decision because you are deciding which is the risk you're willing to absorb, right? Do I want to see it drop in half, or am I going to be sad if I miss the next 50% higher? And that's a good question to ask yourself. And you don't have to sell everything, but you can take pieces of it and sell it. All these CEOs who register and say, we always talk about this. Oh, so-and-so, this one's selling so much. Oh, well, this is terrible. David Solomon's selling Goldman Sachs stock. He must not feel good about it. You know what he's doing? He's being prudent. He says, I have an enormous amount of my wealth in this one company. I am selling some of it, and they do it every single year. Every C-suite executive does that.
You can sell the whole thing. You don't have to sell the whole thing. You can still let some of it ride. It's funny. Michael and I were talking this week. Every time it looks like Bitcoin is setting up for a new bull market over the past, 5 years, Michael and I will have the conversation. Okay, what level would Bitcoin have to get to for you to take a big chunk off the table? And we put our targets on, and usually the goalposts move as Bitcoin keeps going up, and we just don't end up selling. But this time we were talking, we're like, all right, if Bitcoin hits 100,000, if we get in we have to take some off the table here. We're going to sell. And then it's like, yeah, but what if it goes from 100 to 150? And it's like, you have to be okay with that. That's the thing. You have to be okay with that. And you have to know what you're going to do with the money in terms of rebalancing or using it for something potentially. But you have to be okay with the fact that that happens.
Yeah, and whatever your decision is, don't look back. It's not worth it. It's not worth your time and the energy.
No.
Just move on. There's always something new and exciting that's happening, and it's probably a better use of your time than looking back with what your regrets are. If you'd like to learn more about Jill on Money powered by the Compound, just go to our website, Jill on Money. We've got a link to it, and there's a whole bunch of videos there, and it's kind of cool. So let us know what you think. And if you've got a question for us, of course, there's always the Contact Us button on the website. Write us a note. Let us know if you want to come on the air. Sign up for the free weekly newsletter, and remember, everything that we do lives on this website. You can subscribe to us on the Odyssey app or wherever you find your favorite podcasts. Try to do something nice for someone else today. Change your work, change your wealth, change your life. Thanks for listening. We'll talk to you tomorrow.